Welcome to the Dividend Talk podcast, episode 26. Our top 5 sector allocation and why. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with European DGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you're new to our channel, please hit the like button and subscribe to us, and check out our previous episodes on YouTube and Spotify. See you on the inside. Hey everyone, welcome back to another episode of Dividend Talk. We have a nice little easy topic today. We're going to talk about our sector allocation. But before we get into that, I'm here with European DGI. How are you doing, buddy?
I'm in a good humor, so that's already a good a good start because I'm really looking forward for the show today. And never a dull moment, crazy days at work, but I'm really glad that this stupid year is coming to an end with COVID-19, and I hope we don't get COVID-20 because I think 19 is referring to the year, right? So is it then that next year it's called COVID-20?
They must be a year behind, is it? It didn't hit Europe till 2020, so maybe they should rename it.
Yeah, I wouldn't be surprised if someone 1 January calls it COVID-20 because it has a slight mutation or something like that. Anyway.
But speaking of COVID-19, while we're on the subject, there was the first person, which I believe is a lady, received the vaccine in the UK. And I believe, if I'm right, it's significant for a couple of reasons. But the first is it was an elderly lady, and I believe it's the first time a woman has received the vaccine first, which is pretty big news. I'm not quite sure the effects or anything. Maybe you might know, but it's looks to be a positive step in the right direction.
Yeah. Well, the only thing I heard is that I think there are already 1,000 people or something like that, and people with allergic conditions, they seem to get some adverse events there, but it still seems bearable from what I understood. So I'm really curious to the long-lasting impact of the vaccines, whether it's really going to protect us or not, for how long it will last, because we don't have all the data yet, I would say, in the sense of how long the antibodies stay in our bodies. But I think it's really big news, and it's really people said we will have something in Q3. I never really believed that, but anything before the new year, I considered it always as a bonus. It's really nice that we can now start with the elderly that is starting in the UK. So I think for us, more like the younger generation and the healthy generation will probably have to wait until mid next year. But I'm glad it's starting, and specifically for the frontline workers. I mean, they're putting their lives just all the time at risk. So it's really about time that they get vaccinated.
Yeah, it's good news, and hopefully travel will open back up soon. I have to admit, I'm getting a bit, I don't know, agitated. I like to travel quite a bit, and I'm really looking forward to getting out and seeing some new places.
And I'm dreaming of going to, for instance, Croatia next year, just camping or something like that, just where all the crowd is again.
This week, I'm really excited. I spoke to you a little bit before off air, and I know you had no clue what I was talking about. But in Ireland, we have our national game. It's called hurling. They use sticks and they beat each other and they hit a small ball. But it's a really big event in Ireland. The Gaelic Games it's in every community. Communities are really built around this game. It really brings people together over here. But we have an All-Ireland final this Sunday, and Waterford, my county, are in the final, and it's a really, really big deal for us. It's been 60 years in around since we last won it. The last time we were in the final, Galway beat us, so we are really, really looking forward to it. It's going to be a great weekend. If Waterford do win, we will be on our own lockdown for a week, just partying. It's going to be crazy. The build up has already got us excited, so we're really looking forward to it. So you'll know on Sunday if I'm active online, I'm in a really good mood, or if you don't hear from me from 2 or 3 days, you'll know we lost.
But is it like live on television, like Champions League final and such?
Oh yes. Usually it's played in August, so it's a summer game. It's one of the fastest games in the world, so it's a summer game. Obviously, with COVID, it's gone into winter and it slowed it down a small bit. But Croke Park fits 60, 70,000 people. It's usually full. It's impossible to get tickets unless you know somebody or have connections. I have connections in that area, and I go to most games, and I've been to the last final and all that. So I really miss not being there. But hey, if we win on Sunday, I don't care where I am. It's going to be a party.
So good luck. This will be
Thank
really
you.
interesting.
We will need it. We're playing Limerick, and they're quite good. They beat us already this year in the Munster final, so it's going to be quite a tough game. But hey, look, I'm optimistic right now.
So share with us on Twitter the highlights of the final, please. Yeah, I would be really interesting to see how this game really works and how Waterford looks like. What kind of color of jersey?
We are white and blue.
White and blue. Okay, yeah. Good, cool. So maybe then another news item for me is the craziness with IPOs at the moment. We had DoorDash, food delivery, now our Airbnb. Price for 68 at the IPO dollars, shot up to 140 something. I mean, there are two thoughts that I have here. Those investment bankers that are guiding the IPO, they have really done a bad job, effectively, because Airbnb could have got twice as much for selling the shares on the stock market and could have done much more with that money. And at the same time, I said, what the fuck? Why are people buying for these prices? If people now tell me this is not 1999, then I don't believe this anymore. Because for me, this is 1999 from what I read in the books.
This actually reminds me of cryptocurrency in 2017 when you had all these new tokens and coins coming onto the market, running similar things to IPOs and just going to crazy prices and then crashing down after. Like, are you telling me AirBNB is worth that amount of money? It's not. I seen a throwaway comment on Twitter, and it actually resonated with me. And I said, maybe some of these big blue chip companies should go private, and in another year run an IPO and go public again, because the money to be made is incredible. But on the flip side, could you imagine being an early investor before it goes to market and getting these at $68 and it shoots up to 148 as soon as it goes on the market? These guys must be cleaning up.
I actually don't know what they are doing, but for me, it is something of this time and of these times, and I can't take it serious anymore. Simple like that. Because if you just look, I checked the other day a little bit in the beginning, like the valuation, 68 was already quite a lot. Yeah, so it's just crazy. And I wish everyone their profit, right? So if you made quite a good deal on this, then congratulations. It's not my game. It's not that I'm jealous. I'm just concerned about all those people that invest in it, enjoy the ride, but might not know when to step out and then lose all their money. Yeah, because the pendulum usually swings twice as hard to the other side as well. And that's what I'm more worried about, because what you then get is, specifically if these are young investors, they get burned. We might not see them back for a decade. And that's a pity, yeah, because I think for everyone's own empowerment, I think it's really good to be in the stock market. You learn a lot about businesses, you build your own wealth and such. And this is what I'm more a little bit afraid of, that people get burned on this.
Yeah, and what you said right there is exactly how cryptocurrency went in 2017, 2018. And it's still not recovered fully. Look, I know Bitcoin had a recent rally, but the rest of the coins, and they're still way behind of what people would have bought into 2 years ago. And it hurt a lot of people. I know some people invested money they shouldn't have invested at all-time highs. They bought into IPOs at the time, and they're never going to get that money back. And those people will never probably go back into cryptocurrency, even as blockchain and stuff becomes more mainstream.
Sure. Mhm.
And the same will happen with these investors. They'll put money in. Yes, it's good when it goes up. And the fear is that you start to confirmation bias. You'll start going, okay, I can't lose money here. And they'll just keep
Mhm.
investing. And soon it just, the bottom falls out of it. So look, I hope people that go into these know exactly why they're going in, and when they're going to get out. And
Yeah.
best of luck to each person who's involved.
And what I find so interesting, around 1999, these valuations were also really that crazy, right? And for instance, a Microsoft, which might be Airbnb, might be something like what you could argue maybe a tech stock, like Microsoft maybe was in the late 90s. Although I think Microsoft even still had a bit more quality there. It took them also more than a decade to get back to the prices they had at that time. So it might be just that we're soon talking for these tech stocks about the last decade. Because in the end, valuation does matter. Yeah, once those companies start to mature, valuation starts to matter more and more and more when it comes to rational valuations like 15 to 20 PE or something like that.
Yeah, and look, we've spoke before on how we thought, or definitely I thought, that the markets were out of sync with reality and what's happening. And look, we've seen all-time highs and rallies. And the opposite is true in the economy, and it's not all going plain sailing. So maybe next year when we start getting back to normal, COVID starts disappearing, people start living their lives back to normal. I know in Ireland they still have the supplementary payment, the PUP payment. People start coming off that and they go back to their normal lives. We might start to see some sort of a pushback, but
yeah,
it does. Look, it just, to me, it's a scary thought. We're just so out of sync, and like you said, the parallels to 1999 is uncanny.
Yeah.
Okay,
good. So let's start about the main topic, because actually it's a nice bridge to it, because we're going to talk about sectors. And maybe a reason also why I really want to talk about sectors this week, because I've been looking a little bit about my portfolio. I do this every once in a while. And I was checking, like, what's my sector allocation? Why is it like that? My current allocation. I feel like, okay, let's dive a little bit deeper in it. So, I mean, you know this better than me, but there seem to be multiple standards here. And how was the standard called again that we're using here today in the show?
well, we're using the S&P standards. It's the GICS standards. So they've got 11 sectors, which we all know about. And then the UK, we all know the UK like to go out on their own, but they've got the ICB standards, and they've only got 10 sectors. But I suppose for our discussion, we're just going to focus on the GICS standards.
So let's do some historical background first. So I will, when you're listening on YouTube, I'll pull up a table now, which shows the average stock market sector returns between 1974 and 2019. If you look at that, the top performing sector that we had was the consumer staples with 13% average return. After that, we had the real estate investment trusts with 12.5%. The third one was the healthcare sector with 11.9%. And then maybe to some a surprise, but the fourth one was the energy sector with 11.1%. So a lot of the oil is in there. And then you see already more the stocks coming more in a closer proximity to each other, like utilities 10.9. We have consumer discretionary like Disney and something like that for 10.7%, industrials 10.6. But the worst performing sectors were communication services with 9.8% and materials with 8.9%. So if you know this, it's really interesting, because we live in 2019 now, and or 2020. And if you look at the first part of the year, it was really information technology that was really driving the growth. And for instance, information technology itself was really in the former 4 decades. It was like on average around 10%. So it's really interesting to see how technology performance in 2019 was 50%. Yeah, in the first half of this year, it was 15%, while most sectors were in red. So it's clearly that the information technology is not anymore the same sector as it was 30 years ago.
Yeah, technology has moved on. We've got companies now such as Google, Microsoft, that haven't been, well, Microsoft maybe, but Google and the likes that have been around more recently that are really driving growth. So it'd be interesting to see this from a decade on. And I'd imagine information technology might be a little bit higher than what it sits there now.
Yeah. Yeah, and then I think also the companies that you mentioned, also like Facebook, they are really, nowadays it's more winner takes all, I said, industry, let's say, because with the scalability is like unlimited almost for such companies. Yeah, and that's, I think, the difference why within the information technology sector between today with the introduction of and the maturity of the internet compared to how it was in the 70s and the 80s. And what I find really interesting is like some of the worst performing stocks this year in the first half, no surprise, is the energy sector. It had minus 35, but also the financial sector with minus 23. And the industrial sector, utility sector, minus 14 and minus 11. So it just tells you like you could almost say like the old industries, traditional industries that have not really been changing yet due to the introduction of internet technology and such. They seem to be really lagging the other sectors. And these are also sectors that I said, I just more traditional industries, let's say.
Yeah.
Okay, so what it means then for if we start looking at my portfolio, and I'll also while we're talking about it, I will pull our pictures up, right, for as a support. But I'm currently invested the most heavily in the consumer staples sector. At the moment, I'm 28% allocated to this sector. Now, what means consumer staples for me? It means Danone, Unilever, Ahold Delhaize. They form a really large portfolio of my part of my portfolio at the moment. The reason for that is that I've been, of course, really building up in Danone this year. But it was also because I had the goal this year to give myself more exposure to the European stocks to do some more currency diversification. And this was not the case before because energy was the biggest. And energy is now in the 4th place in my portfolio with 12%. Now, there are 2 reasons for that. I stopped investing in the energy sector because of the fundamental changes with the introduction of COVID-19. I'm not sure whether the new normal will put like an invisible hand above the market, pushing it down. And at the same time, of course, the stocks crashed because I'm still on most of my positions like ExxonMobil and Shell. And Shell, I had a really big position and still 30% down or something like that.
Yeah, so consumer staples, when I think of consumer staples, I always think of companies that have something that you will always need. So you mentioned Danone, for example, or food companies and the like. So well, they're always at, I suppose, the head of a defensive setup. And typically, for me, they are my top. I think they're my top as well. I have 23% of them in my portfolio. And again, I quite think of my allocation as a defensive setup. Consumer staples, information technology, and healthcare. They would be my top 3, and that's by design because they are the 3 that I believe we will always need. With all sectors, there will be some risks to consider. I mean, I know that they're at the consumer staples at the center of every defensive setup, but what are some of the risks with having too much exposure to this sector?
So when I think about the consumer staples, I think about, for instance, when I think about Unilever as an example, right? So what I've seen since the year 2004, 2005, there was a trend in globalization. So entering the Asian markets and such, right? India, China, these kinds of markets. So you could argue now in 2020, almost 2021, how much room is there still left to grow for some of those companies? Because they have already quite a deep penetration in many countries. So I think the big bang has already been earned there. And at the same time, another risk that I see is the aging population. So what that means, like many people are getting more, well, you know, the boomers are slowly dying, let's say like that. I know my grandparents as people that always went to the supermarkets, bought their brands, canned food. But I'm already in a generation where we go more to farmers markets and everything. So is our share of wallet, and for the millennials and such, is that one just as big as for the boomers when it comes to buying everything in the supermarket? I'm not sure about that, but when I think about these kinds of things, so the changing preferences between our generations, I think that could be a risk for consumer staples. But I see them as small risks because I think the consumer staple sector is as defensive as it gets. It's supporting the bottom of the Maslow pyramid of we all need food. So that's why, like to your point, I've designed my portfolio around the consumer staples because their dividends are more secure from that point of view, at least according to my opinion. And this would suit me better in retirement. It will probably take me less, gives me less fear at the moment, at that time, for dividend cuts.
And you mentioned an aging population as, you know, one of the risks of this sector, and I suppose that leads me onto diversification and why we have diversification in our portfolios, and again across each sector is important, and that's where healthcare would really benefit. So from one side, consumer staples is look, it can have an effect on that, but it's a positive effect then on the healthcare. So that's, for me, that is why healthcare would be within my top 3 positions.
Yeah.
Just for that reason alone, we have a massive aging population, and it's worth knowing that, and it's worth knowing that in the next 10, 20 years, it's going to put real pressure on our society. So healthcare for me is important to have in there as an offset to consumer staples.
Yeah, and there's a lot of wealth in that group. I've seen a chart the other day that I think above a certain age, probably about 50 or 55, I think 90% of the wealth is concentrated. So, you know, they can also pay for higher drug prices, right? So, but to your point, for me, maybe also to talk about my desired allocation here, because it's probably a good moment to talk about it. So for me, consumer staples and healthcare, I both desire them to be 18%. So consumer staples for me is currently 28 because I'm still in the accumulation phase, and Danone was for me an opportunity not to ignore. But they will be both my biggest sectors, I hope, in the future. And specifically for those reasons, I think the bear case for healthcare, how I look at it, is probably the drug prices. And specifically in a country like America, I know that some of the stocks that I have, like AbbVie and Novartis, they really benefit from the high drug prices in the States. So if, for instance, there would be a political change there, in the sense of that they're really going to fight the prices, this might really suppress the future growth prospects for some of the healthcare stocks in my portfolio. For now, I think I'm good here, but it's something to keep an eye on, I would say, the political risks there.
You mentioned your desired portfolio, and you put a number, 18%, on both consumer staples and healthcare. How did you come to that level? Why 18%? I know when I started, it was something that I struggled with. How do you define what each one is?
Yeah, so in general, I told myself there are 11 sectors. So I at least don't want the sector to be bigger than 20% in my portfolio. Yeah, because look at the energy sector now. Yeah, energy sector this year was really down as a whole sector. So if I would have had 50% allocated to one single sector in my portfolio, I would have been crushed. Yeah. It still hurt it because I was probably on 24-25% at the beginning of the year in energy, just for the fact that in the early allocation, I say accumulation stage, I don't mind to be above those percentages. But I told myself not more than 20%. And then I just started to look at what kind of sectors I would like to have most. There are 11 sectors. And then the 18% was a result of that, yeah, because I do want to have some utilities in there, but just a little bit. I do want some real estate in there, but just a little bit. And if you start doing like that, then, for instance, you consume already 30%, and then you have the other 70% left for 5 sectors or something like that. So that's how I came to these numbers. But I set myself the rule that I don't want it to be above a certain threshold because of the risk, single sector risk, let's say, in my portfolio.
Yeah, that's given me something to think about, because I've actually changed my mindset on how I approach this year. So at the start of the year, I was really focusing on getting the right mix of, 20% consumer staples and so on, and defining these percentages. And I found like I was over focusing on them and maybe missing opportunities and companies because I had a certain amount of a stock and I didn't want to overextend myself. So towards the middle of the year, I kind of shifted and I picked my desired portfolio. Okay. And I picked the companies that I want to have in my portfolio. And then from there, I just, whatever sector they were in, I put them into, as I mentioned, I put them into 4 different tiers. I have an overall figure that I want to reach. So each tier has a monetary value of what it will look like at the end. And from there, I derived what my sector allocation would be. But to your point, I'd never thought about the risks of what if we have a downturn like energy has had. So I have consumer staples here as 24% of, based on my desired portfolio. Information technology is 26%. That's a quarter of my portfolio. So there's a big risk there that I maybe need to consider a little bit more. The only thing is that I'm still not finished designing my portfolio. I have 26 companies, so there's still space for 6 more. So this is going to change when they come in. But my focus this year was really to define the companies that I most want to invest in, and then the sector allocation will be as a consequence of that. Now, obviously, I wasn't going to go all tech stocks or all into one, but I didn't focus on it too much. I did at the start of the year. I felt like I was getting a little bit bogged down trying to get the perfect figures, and I just changed my mindset on how I approach it. I maybe will go back and think about the risk a little bit, but for now, I just want to get a list of 32 companies that I'm happy to invest in, and then maybe 6 or 7 more that I have on the sidelines, and see where I go from there.
But I did something similar to that, right? So I did your approach as well. Yeah, and then I compared it with my desired sector allocation. Then I started to play with it. So I left a few stocks out because I noticed like, I've got too many consumer staples or something like that on my desired allocation. So, but I also just looked at all the companies that I wanted. So I also made my shopping list. I have also my 4 tiers. And if something changes that I really would like to swap the other stock, and the stock becomes not tier 1 but tier 2, and then it becomes 17%. I mean, that's for me like penny wise, pound foolish, right? For me, it's more the limit of 20%. It's kind of a hard limit. That's not what I would like to go over it. And we have seen, for instance, the consumer staples being impacted. I think it was in 2017 when Amazon bought was it Whole Foods. Then at that moment, many consumer staples like Walmart, Target, Ahold Delhaize, they really went straight away 30-40% down just because of Amazon. They came up again half a year later, but imagine that Amazon indeed was able to sweep out the market. Yeah, that's where you see the single sector risk really, and this can happen to IT as well. And I mean, maybe an IT is so diversified and so huge, but yeah, what if regulation comes in, the big companies need to be broken up, it might suppress the valuations of IT companies and such. And actually it would be for us now that those would be brilliant buying opportunities, of course. But for those reasons, I think I wouldn't, and then this is my comfort level. It has nothing to do with theory or being, I would say, following the science here. It's just my personal comfort level of how I look at it.
Yeah, risk level is very, very important. And how would you feel if, as you said, energy sector dropped 30% and that's 40%
That's
of your
what happened.
portfolio? Yeah.
Yeah,
So
and that's what happened. So
and the danger for me when I was researching this, you read of defensive portfolio allocations, but that doesn't mean they're not going to drop and drop hard. They have done in the
yeah,
past, as you've mentioned. They're not bulletproof. If you go back to the start when you spoke about the returns, the average returns, and it's quite interesting actually. We had some standout performers like consumer staples. Yes, it was 13%, but look at financials or look at industrials, for example. It's 10.6%. So it's not a huge difference. So my point would be, just because it's defensive doesn't mean you have to overextend yourself in that. There is other sectors, and your returns maybe might drop 1% or 2, but over the long term, you'll have a more risk efficient. You won't risk as much in your portfolio over time.
yeah. And what's probably also good to mention is that those are past returns based on secular growth trends at those times. Yeah, in the 80s and 90s was a total different world than nowadays. So we need to, I think, consider that as well. But having said that, my top five from my side to conclude this. So my top five currently are consumer staples, IT, healthcare, energy, and industrials. They make up approximately 70% of my portfolio already at the moment. But my desired allocation is the I would say the same top five, yeah, which is consumer staples, IT, healthcare, and then I've got three actually on the same level. This is energy, industrials, and consumer discretionary. For me, really, where I don't want anything really is financials. So, but I have some allocation here because of insurance companies that I like in my portfolio, but I don't want banks or something like that. Materials as well. I mean, I don't see as materials as something that I feel comfortable with. And I mean, I have a little bit there, but for instance, maybe copper is now really hot because of the EVs. But then that's not anymore for me dividend investing as such. Then I'm really theme investing based on some certain trends and growth investing. So generally, yeah, I would say I'm overweight in those sectors. How does it look for you, EMF?
Yeah, so my top five are consumer staples and information technology. So both of them, as I said, are around 25% at the moment. 24 for consumer staples, 26 for IT. Healthcare comes in at 12%, which is maybe lower than I would have thought. And then I've got communication services because of my investment mainly in AT&T, and energy then comes in at 8.6, and that's mainly because of my investments in Shell. But when I look at IT and consumer staples, I'm actually not surprised they're the top two, because my strategy seems to be to try and pick companies that are depressed in value. So, for example, Intel and Cisco in the IT sections, and so on, and Shell in the energy section. So I'm not surprised they are where they are. But compared to my desired portfolio, I'd really like healthcare a little bit higher on that. And communication services, I don't really want that in my top five. Really, I'd like to see either financials. I know you're not keen on financials, but I like Aflac, for example, and Munich RE. I'd like to see them a little bit higher, but I'd also like to see real estate and REITs in there. But my investments in REITs or in real estate was a little bit higher. I used to do crowdfunding in I, it's a website in the UK called Property Partners. I know there's a few guys on Twitter that do that, but I've pulled everything out of that. So my allocation has really gone down on that side of it. So I'm looking at a few more REITs to add to that to maybe prop that up. At the moment, it's just realty income. But yeah, look, I'm liking where it's going, and I like my strategy of maybe focusing on quality companies. And as you said, we're in the accumulation stage, so I'm not focusing too much on it. But you have given me a little bit food for thought on 25%, 26% maybe is a little bit high. So I'll have to maybe rein that back. Maybe 20% seems a good number, but I just need to figure out my own kind of risk to reward ratio.
Super. So let's conclude here then about our sector allocations. I hope it is also interesting for the listeners. It's not something that people discuss a lot about, right? When we usually talk about portfolio allocation and about the individual stocks that we have. So I hope it is just in general food for thought. You know, the holidays are coming up. Always a good time to reflect on the year, to do some reviews, to recalibrate for the upcoming year. What you want to do, what are your goals. So yeah, let us also know later on Twitter if you have any follow-up questions. We're more than happy to answer them. Having said that, we have quite some listeners' questions again today, EMF. Shall we just start?
Let's do it.
Okay. So the first question, like always, and I think it's becoming a tradition, is Phil. With regards to your favorite stocks, do you want prices to go up or down?
I want the prices to go down, but it's something we struggle with as dividend investors. You do want the price to go up overall, but human nature, when they go down, people tend to panic. And I know I can speak about social media. I mean, every day there's people, my portfolio is up 2%, it's 3%, and constantly checking. I'd wonder sometimes, are they really dividend investors, or are they really long-term investors? Because focusing on these miniature moves, or 1 or 2% each day, is it a green day, is it a red day? I mean, it must be exhausting for one, but it's not the end goal for me. I like when prices go down, but I'm more focused on where the company is going in the future. For example, Intel. Look, they've gone down really hard, but I'm still optimistic, I suppose is the right word, on where their future is going. IBM as well, they've had a terrible 10 years, but I'm a little bit more optimistic with the split in the company and blockchain. It doesn't mean I could be wrong, I could fall flat on my face, but I have optimism for these companies, so I'd rather buy them when they're down rather than buying them when they're at a high valuation. So I do want prices to go down. I think every dividend investor will know the struggle, and Phil said it himself. We want them to go down, but we want them to go up.
So I can tell you my look at it. I want share prices to go down, and I want earnings and cash flows to go up.
That's probably a better outlook.
Plus the dividends.
Yeah.
Okay. SEGOINVESTOR. Do you guys use the moving average to get the buying price? If yes, which one?
So I have to say no, I don't. But I will say that the Wolf of Harcourt Street wrote an excellent post. It was a guest post on my blog, and I linked to it here about that subject, and it's probably worth checking out. Technical analysis is something that has always intrigued me, and I have a couple of books behind me on that subject, but I've yet to dig into them. I really want to, but I'm kind of scared to at the same time, and it might make me take my eye off the goal and focus a little bit too much on them. And they're nice to have, and they're nice to check, but for me, technical analysis is not my strong point, and it's not the main feature behind my thesis. So I might swerve it for now.
Okay. I've got nothing to add there. Same here.
Okay.
Then we have Wolf of Harcourt Street, and he asked if we had a look at IIPR already.
No, I haven't, and I've put them on my Trello board, so I will get them. I just don't know when. It will be next year. Schedule's too busy coming up to Christmas. It will be next year. They did interest me, and again, his post is a really nice Substack actually, and it wrote some really good posts. But it has inspired me to look at him, and it's a really good take on entry into the cannabis markets. It's not something I'm overly familiar with. It might take off, it might not. We don't know. Regulation, as you know, has huge bearing on what happens. But a REIT in that sector might be the safest option to go, because you can always use these warehouses for something else if that doesn't take off. So it looks like an interesting prospect, but I've yet to dig into the numbers and so forth.
Yeah.
Okay, so we have another question from EasyMoney, and he has asked us, why is ticker symbol AD, the best retailer of Europe?
So I will not I mean, I did last week's talk about Ahold, right? I'm just thinking, is it the best retailer of Europe? I wouldn't claim that in the sense of from a consumer point of view, because Ahold is really penetrated in the Netherlands and in Belgium and in the US, not much further in Europe. Yes, it has something, but not too much. If I think about the best retailer, and I guess he's talking about supermarket chains, not about other kind of retailers. I would probably think that Lidl is probably even better. But when we start thinking about it from an investment case point of view, what I just love really about Ahold Delhaize is their power in the supply chain, their innovation, their product innovation that they have always been doing. That's how I know it from the Netherlands. They also bought bol.com at the time, which is kind of the Dutch version of Amazon. So, which gives them a lot of know-how about running a digital business, and they're also growing really quick at the moment, or really fast in delivery and such. And they've been able to use bol.com technology as well in the US to transform. That was one of their major goals, I think, 2 years ago. So I think this company just has all the tailwinds at the moment, and that's why I think it's one of the best investment cases in Europe when you think about consumer staple candidates, when you want to have something like Walmart or something like that, but then in Europe.
Yes. Okay, I've nothing more to add on that, really. So I'll ask you the next question from Dividend MVP. How do you come up with a fair value of a stock?
So, I what's probably good to know is, like, I had some accounting at school, so business school. So I learned how to do discounted cash flow analysis, and yeah, this is how I can calculate the fair value of a stock. But the calculation is one thing. There's a lot of sensitivity there, and for instance, applying a discount rate. So the discount rate, or the way that the average cost of capital, you need to see it as how much does the company need to pay for money by either going to the bank and pay an interest rate, or go to the stock market and have, for instance, investors expecting a 10% return or something like that. So this whole mix of how much money costs is called something discount rate. So these are really sensitive. It's really easy to make mistakes in that. Sometimes I have a feeling that I have a tendency to overanalyze these kinds of things, and I started to this year more to use common sense, and I think it's doing me better when it comes to fair valuation. But to also to mention to Dividend MVP, I think one of the most important is not so much the calculation, but it's your understanding of the business and what your take on their growth prospects are. Because when you are doing a discounted cash flow analysis, an example, you need to assume some growth rates, and for that you need to understand the business, you need to understand the market. And I can tell you, something like Johnson & Johnson is almost impossible to think about a growth rate. So here I look more at the history of such a company and their cadence every year, 6-7% growth, and I do then use that for future look. But in some other companies, I have a feeling like, oh, there's a catalyst coming up, so if I look at the history, probably it will be a bit more, or I think they are more having headwinds, so it will be a bit less. And that's usually how I use those forecasts, and that's then that I do my calculation about. But Dividend MVP, I think it's important, and we recommended it in one of the earlier shows. If you're really, really are passionate about investing and want to invest in single stocks, our strongest recommendation is to do at least an accounting course, so that you learn the basics of how to read statements and how to do some basic calculations, because that will really help you in doing these kinds of things in fair value. And I find, for instance, looking at a PE of 20, I don't find that fair value, because often the earnings are misrepresented, because they can really financially engineer that.
Yeah, so in terms of tools, I use a template that I got from your website, the cash flow from your website. I also use a dividend discount model. It's a multi-stage model that I use. Again, you have some assumptions on that, but it was the Sunday investor who helped me come up with this and design it, and he did a lot of work. I use the two of them to help me calculate the fair value. You mentioned P ratios. I don't go by this value of 20 as the figure. I tend to look at the historical value over the last 10 years and what the average is, and if they're below that, they might be undervalued, and if they're above it, they might be overvalued. So I tend to take an average of these three figures and use that as my fair value. Sometimes I check Morningstar and other sources as well, just to compare that. I'm not completely off the wall, but like you said, it's important to understand the potential growth rate of a company. We'll never know what they grow at, and you'll get that from their reports. Their annual report, they'll give you estimations of what they believe. They're going to be optimistic, so you can normally go below what they say. But in terms of tools, I'm happy to share my spreadsheets. Just drop me a line and I can share them away. But that's typically what I would use to start getting a valuation of them. Okay, and we have another question from CENTRINO. And I knew this question was coming because I kind of wrote him privately about this, but I maybe ask you and get your perspective. And he says, sometimes I see people making buying, selling decisions based on RSI. Is this index a good starting point, or what other indicators could be used to make better decisions?
So this is the relative strength indicator, right?
Yes.
Okay. So sometimes, but in 10% of the cases. So sometimes when I see that the stock is really under stress and it's been falling for days and I want to buy it, but I'm doubting whether it's the right time, I might look at the RSI. And actually it's the only thing I'm looking at. I'm not looking at the moving averages or something like that. Okay, sometimes, but only at the RSI, because it tells me if it's oversold or overbought. And when it's oversold, I know that there's potentially a likelihood that it will not drop another 10% overnight. But again, this is in those rare cases that a stock is falling hard. Usually I wait anyway until it bounces a little bit, because I want to avoid a falling knife situation, and I don't need to bottom fish. But yeah, and only in those cases I might look at it. Other than that, not really, because I know I've done my fair valuation. So usually I buy more like 10% under my fair value, then the next one 15%, then the next one 20%. That's more the way how I average down, and I don't then really care about RSI or moving averages so much.
So my take on it was, an RSI is a lagging indicator. Moving averages are lagging indicators. So they're basically indicators of what has happened in the past, not what's going to happen in the future. You also have time scales, different time scales. Do you use a month, a week, an hour? Which one are you going to use, and why? Depending on your strategy. Like short-term traders might use the RSI on a 1 hourly basis or 15-minute basis. What would you do that as a dividend investor? I don't really know. Honestly, I don't know. If you're investing for the long, if you're investing for the long term, why does it matter? If you're investing for the short term, then you need to know how short that is. Are you investing for the month? Are you investing for the week or the day? And that will tell you the time scale you need to look at, because each RSI will be different on each time scale. I look at it when I am doing my fundamental analysis. It is one of the last things I look at. I think it's 1 or 2 points out of 100. And really I look at the long term. So I look at the monthly. And if the monthly one is at 70 or above 70, there's a high chance it's going to dip down below, and I might hold off. But I don't use it to make decisions. It's useful to know if something is overbought or oversold. But again, it's completely strategy dependent, and as a dividend investor or dividend growth investor, I'm not sure where it actually fits in.
So you make me reflect on this, because one of my investing principles is to invest without emotions turned on. And when we look at an RSI, it's all about emotions, right? Oversold, overbought. So probably I should even stop looking at it in those rare cases, because it makes utterly no sense then for me. Anyway, thank you, Centrino. Good question, but I think as you heard that we're more looking at it from other point of view. So next question, just dividends. Now that the year is nearly over, did 2020 impact your strategy or allocation targets? I think we spoke about it already a bit today.
Yeah. I'm not sure it was because of 2020 and COVID. It's just my mindset has changed and how I look at things have changed over time.
Yeah. For me, it's a bit too early, just dividends. I would need to look a little bit deeper, but generally, I don't think so. There's not really a lot changed in my approach. I've been executing rather to my plan, and I'm really sticking to my plan all the time because I know my unwanted roommate is an impulse and such. So I try to therefore stick to my plan because that's my fail safe.
Cool.
So the next question is from King, and he asks, why has Aura lost 3% this morning? Ticker symbol Aura.
Yeah, I don't know, and I think I've mentioned this in one of the earlier questions. I'm not really into looking daily into the price fluctuations if it's down or up 3%. I out of curiosity, I did look at this ticker symbol earlier, and it was up 2%. So maybe it dipped and then it went back up. I don't know, but for that kind of reason, it doesn't interest me one bit what companies are doing on a day-to-day basis. Is their dividend safe? Do they have future growth? Is their cash flow growing? That's all I care about. 1 or 2% a day going up or down, fluctuating, that's not for me.
Yeah, I understand.
Okay, and then the last question is from DANE, who asked, what are your views on diversification needs in a portfolio of various sizes? So say for 10K, 50K, 100K. So essentially your early accumulation phase versus the later stages.
Well, it's actually really simple for me. First of all, 10K for me might be something else than 10K for you. I live in a low income country. If you live in a high income country like Switzerland, then 10K might be 1 month salary. Definitely not for me. So for me, 10K is already quite a lot of money, to be honest. But I don't think like that, honestly, because let's say that I invest €1,000 a month. Yeah. Then of course, if I have 10K, then I can have maximum 10 stocks. Yeah. So the more and the more my portfolio grows, the more I can start diversifying. So and for me, all the way up to 100K, and I passed the 100K, is all accumulation phase. So I'm tracking my allocation, but I have already my tiers. Yeah. So for instance, a tier 1 is for me not more than €20,000 in one stock. Yeah, and tier 2 is 15, tier 3 is 10, and tier 4 is 5. I have nowhere reached 20 yet, so I'm probably using more that approach, and then the diversification is already baked into my approach. So it's not really about the amount of money at a certain stage in my portfolio.
Yeah, regardless of the amount of money, as you said, it's different for each person. It really comes down to what you're really willing to risk, and how you would react to a loss of a certain amount. So as you said, 10K might be a lot for somebody, it might be pocket change to somebody else. But if your portfolio is to drop by 50%, how do you react to that? And that your risk management is, or understanding what your level of risk is important when coming up with sector allocation. I think, regardless if it's the early stages or the later stages. For me personally, I'm not paying too much attention to it. As I said, I've changed my mindset into picking the companies that I want, and then I'm trying to invest in them when their value is low, or
Yeah.
when they're good to buy. But it'll be interesting for me to track how my mindset will change over time as you start getting into, say, reaching financial freedom with dividend investing. And if I had aspirations of retiring early, which I probably won't, but if I did, how would that impact my decision making? Because at that point, your risk level will be a little bit lower because it's now impacting your lifestyle.
Yeah,
So
exactly.
it's definitely food for thought. But at this moment in time, I'm in the accumulation phase, so I don't pay too much attention to it. But each person's risk is different. And said one person might lose 1K of 10K, and it might be the end of the world. And some people can tolerate that. So understanding your risk is key.
And we know that we all know that Ireland is the end of the world. So
No, it's when you sail past Ireland and you fall off the edge of the ocean, the Atlantic Ocean.
okay, so thank you all for all these listeners' questions. Really diverse this time. It fits well on the topic of sector diversification as well. So thank you all. Keep them coming. We love, as you hear, we love answering them. So yeah, and this week I'm screwed with a stock pick, right? So I I really like the stock you picked last week, and I really like they were picking European stocks, yeah, because it's really attractive to go into US stocks because they are probably more well known by some of us. But so I also made an effort again to take a European stock this week, and actually I took one that I'm all the time pointing my eyes at, and I get sometimes the question about this stock, and the Spanish listeners will love it because it's Iberdrola. I don't know if you even pronounce it like a Spaniard does. But why I'm picking this one, what I love about this company, it's quite an old company, but it has been transforming into a real green energy player. So when we talk, and it's a utility, by the way, right? And what I think this is one of those stocks that I would love to have in my portfolio from a point of view that, you know, I want to do something with the climate change and a good player on it. And I don't really have that in my portfolio yet. And this is a company that's full in it. It's really also in their mission statement and such. And they're really focused fully on it, and they are big in wind energy. But as an example, what they have written in their purpose, so they say, we are the utility of the future. And with over 170 years of history behind us, Iberdrola is now a global energy leader, the number one producer of wind power, and one of the world's biggest electricity utilities in terms of market capitalization. And here it comes. We have brought the energy transition forward 2 decades to combat climate change and provide a clean, reliable, and smart business model. This last sentence is the reason why I would like to be invested, because this resonates so much with me, and I think there is a lot of money to be earned. But if you then start looking a little bit about the money to be earned, well, it's not so easy for them, because if you look at what happened over the last 10 years, their revenue has been trading in a range between 30 and 35 billion. So it's not like they have been able to turn that already in quick revenue growth, but it also shows a little bit that they are transforming. This transformation has also led in 2014 to cut their dividend by 11%, and that's usually why it drops off again. Every time when I look at it, I think like, oh, they cut the dividend in 2014. But you know, it's just 11%, so maybe I shouldn't be too tough on them, because they have been growing their dividend quite rapidly ever since. So in that sense, it's going to pay 40 cents now. The stock price is around 11.30. What is also good to know is that they are really focused on the dividends, and I think they mentioned that their payout range should be something between 65 and 75%. So they want to pay back a lot of their earnings into dividends. So they have kind of a shareholder-friendly policy. And what I therefore like is that until 22 or 23, they are really focused on growth here. So let's see how that goes. But then comes a little bit the annoying stuff that, you know, the price is at 11.30. It's close to their all-time high. Their all-time high was in 2007. So they went quite through a dip since then. But if you look at it now from the last few years, it's really at a high valuation, or no, at a high price. Maybe, sorry, at a high price, not necessarily valuation, but it's a utility. So you pay a price to earnings of 20 for it, which is really high for me for utilities. The dividend yield is nice with 3.5%. Again, for a utility, you usually expect something around 4.5%, 5%. Their 5-year dividend growth rate looks quite good with around 7%. Their EPS is within their EPS payout ratio is within their boundaries of 72%. Their EPS has been growing, but what concerns me is their free cash flow. And their free cash flow has been really poor over the last several years, sometimes in the minus, sometimes just in the plus, and it's because of their large capital expenditures. And this is for me kind of a red flag, because definitely how is it, the free cash flow is underwater with that, if you count in dividends as well. So it's a bit of a mixed bag for me, this company, the utility. I love their vision. I love what they're working on. As a company, I just don't find their stock strong enough for me to pull the trigger to add it into my portfolio and start building a position. I want to see some better results there in their cash flow, to be honest. So this is Iberdrola. I keep on having an eye on it. Every few months I'm looking into it, because someone tells me, did you look into this stock? And I think, yeah, I looked in it, but I don't remember why I went away from it again. And every time it's about the same thing. So I hope I will remember it next time better. But why I'm sharing it today is I think that if you want to have a utility in your portfolio and you can see through the fingers a little bit about their cash flow, I think it could be a really good addition. It's not necessarily my recommendation as a stock pick, but it's more like a stock that I wanted to talk about today. That's how you should see it.
Yeah, it's a really interesting choice. And at the beginning, when you were speaking about the purpose and climate change, and you really had me hooked, and I was like, wow, this looks like a really good company. And then you start talking about their numbers, and to be honest, the numbers don't really impress me. What I would probably like to do now, and you'd give me some food for thought, is maybe check some of their competitors, or maybe companies that are ahead in the climate change race that maybe don't have to spend. Like, I can understand why their free cash flow is poor. If they want to make this transition to combat climate change, you're going to need to spend in the capital expenditure. So look, it's understandable, and if you're, I suppose, bullish in that sense, they might be worth looking at. But I might want to check out some of the competitors that may be ahead in that. But no, really nice choice, and you've raised the bar for me. Next week I need to go and do some research.
Good. So I think we're concluding show again for today. Thank you, EMF. Like always, I really love talking to you about stocks and about dividend investing. Today was really interesting for me also to hear your thoughts about sector allocation. I'm sure that over the Christmas days, when maybe when we have a boring day or something like that, that I will light up the chimney and go through these kinds of calculations again to see if I want to shift something a little bit or not, because it's always the time for me to do the reflections and to set my goals for next year. So thanks for today. Also, thanks for all the listeners. And let's speak to each other again next week.
Yeah, we'll see you next week. Thanks everyone for listening, and see you over the Christmas period.